Welcome to the video to continue long-term liabilities, and on this one we're going to cover warrants and conversion bonds and hopefully maybe notes payable, I think. So we'll see. First one we're going to do is warrants, and what a warrant is to try to make the bonds more attractive. Sometimes the company will do is attach warrants to the bonds, and then the warrants allow the holder to purchase stock at a set price. So what we have to do is kind of come up the value of the warrants and of the bond. Now what we're talking about here is actually detachable warrants, which means the warrants can be actually sold separate of the bond. So after you receive the bond, you can sell the warrants to somebody else if you don't want the stock. So we have here, the company sold $600,000 worth of 8% bonds at 102 for $612,000. Because you take 600 times 1.02, that gives you the 612. Each $1,000 bond carries 8 warrants. And what we need to do then is to calculate how many bonds do we have. So we have the 600,000 divided by $1,000, which means we have 600 bonds. So we'll keep that in mind so we don't have to calculate it later. Each warrant allows the bondholder to purchase $2 par common stock for $30 each. And bonds are quoted at 98 X rights, which means that they'd be selling $98 without the warrants attached. And the warrants are quoted at $4 each. So what we need is to calculate the values that we would have for the bonds and for the warrants. So what we have is we already calculated 600 warrants times 980, that's the dollars that you receive per bond, 600 bonds I should say, because they're 98 X rights, so 98% of 600,000 divided by 1,000. So that's why it's 980. So it's 980 times $1,000. That's the value of each bond. Let's do it that way. Then we divide this by the 600 bonds times the 980. Plus the warrants have a $4 value times the 600 bonds that we have times the 8. And we take that times the 612 purchase price. Okay? So if we do this, we copy, come down here, we paste it, and we put a equal sign in there, it should calculate it for you. So it's 592, 648, 22. Now the value for the warrants, we do the same process except we take the $4 times the 600 times the 8, divide that by the same denominator, 600 times the 980 plus the 4 times the 600 times the 8, and then we take that number times the 612,000, just like we did before. Okay, so we copied and pasted down here, and then an equal sign in front of it. Oops, what did I do? Oh, I forgot the parenthesis there. There. So let's go up here and fix it. So we have the parenthesis in there, so we can just copy it. Okay, there we go. Okay, so that's the value of the warrants, $19,351.78. Okay, so this is the cash we received is $612,000. The discount that we have would be equal to the 600,000 face value minus the value of the bonds, the 592, or 7,351.78. Bonds payable, 600,000, and the common stock warrants are the 19,351.78. So these two equal this time. And here we calculate the number of warrants. We have the 600 times the 8. And 4,800 warrants. Okay. Now, so I could have just used 4,800, but that's okay. 10% of the warrants are exercised, and that's why I had the 4,800 times 10% is 480. And remember, they bought stock at $30 each. So we have equal 480 times the 30 of 14,400. The common stock warrants is equal to, let's do the round function so we don't have any problems later. Okay, that number times, remember we issued 10%, comma 2, or no, 1935, that's the value of the warrants that we used. Common stock was 480. Each bond has, I forgot what, each bond has 8 warrants attached to it, and it was $2 par value. Okay. No, it's something different. I don't want the $8. It's just $2 par value. There we go. 960. Okay, so do that again. We have the 480 warrants times $2. 480 each warrant gives one stock. 480 times 2 is 960. Okay, and then this is the additional paid-in capital for common stock. Is simply the difference between the two to make them balance. So it's 15,375. If the warrants expire, the balance of the warrants expire, we have that total minus what was exercised, or 17,416.60. Okay, so that's the warrants. If you have problems, you go through that again. The hard part is doing this up here. Okay, we need 600 bonds and 980. You take 98 times 1,000, gives you 980. Now that's 98%, so 0.98 times 1,000. That's the that's where the 980 came from for each bond. All right. Convertible bonds. This is another way of making it attractive. This is at the convenience of the bondholder can convert the bonds into common stock. And this is 50 shares for each $1,000 bond at $2 par value. Okay, so what we have here, there's two methods, book value method and the market method. For the book value method, that's the easiest. There's just 20,000. That's the bonds that we converted. You had $1,000. Okay, that was $1,000. 21,000. So it's that's $1,000 premium. We want to get rid of. Now this is how many bonds did we convert? Well, we converted 20 bonds because it's 20,000 divided by 1,000. It's 20 bonds times 50 shares, because each bond is 50 shares, times 2, which is $2 par value, or $2,000. And then this one is simply, let's make it balance. And that would be your 19,000. Okay. Market value method, we use the market value of the stock. This is the book value method, is the book value of the bonds. This is the market value of the stock. However, this is still going to be 20,000, and this has to be 1,000 because that's what we converted. Then we come down here and we get the stock. We do it the same way. We had 20 shares times 50 times 2. Okay. Then we have 20 equal 20 shares times 50 times, let's do it this way, 25 minus 2 gives you 2,300, because the additional paid-in capital is anything you receive above, and it was $25 a share. Okay, then this one here is to make it balanced. So we have 23 plus 22 minus 20 minus 1,000, or so you lost $4,000 on that, on the conversion. Now it's up to the bondholder when they want to convert. Okay, now for the notes payable, I wanted to go over this one because there's a problem like that. It can be a little bit tricky. Not too bad, but maybe a little bit for some. So what we have here is Hamlet Company purchased used equipment paying $50,000 down, and then agreed to pay $30,000 each year for the next 3 years, and the interest rate is 9%. So we have to use the present value tables. So we have $30,000 times 2.531295. Okay, this is for the present value. What we're trying to do is find the present value of the note, of the notes payable. So we have equal 30,000 times 2.531295, and that gives me 75,938.85. And then we added the $50,000 down payment. So the total that we paid was $125,938.85. That's the value of the equipment. So for the value of the equipment would be the $125. The discount on notes payable, well, the total notes payable is $90,000, right? If I follow, that's $30,000 for 3 years, so that's $90,000 minus the $75,000, or $14,061.15. And the notes payable is equal to the 30,000 times the 3, because we recorded a gross amount, and of course the cash is simply the 50,000. So what we have here, we need to, so the notes payable, like I said, is equal to the 30,000 times the 3. Carrying value was the $75,000. The unamortized discount was actually the difference. Okay, and this is a set dollar amount that we do each year, 30,000. The interest expense will equal round is the 75,000 times 0.09, because it was given the problem, it was a 9% interest rate. Okay. The amount applied to principal is the difference. Okay. Unamortized discount would be the 14,000 minus the 6834. This one here is the 90,000 minus the total 30,000. And the carrying value then is the difference between those two. Also, you can take the 75 plus minus the 63, let's do it that way. 60,000 minus the 72. Let's do it that way. You could add the 6,800 to this. Okay, then what we'll do is take that and copy it down. You'll notice we're off 2 cents. That's because this one here should equal that. And then the rest of it's okay. Okay, so notes payable. This is, we got the entry recorded already. So notes payable is 30,000. That's how much we're paying. Interest expense is 6834.50. Cash is 30,000 each year, and this is the interest expense for the first year. For the second year, we look at 30,000, 47, not 49.60. Cash is at 30,000, and the 47.49.60. And the last year, 30,000, 24.70. Okay, and cash is the 30,000, and whoops, hit the wrong button there. Equal 24.70. Okay, and that pays off the note then. Okay, so this is how you do it. You notice this chart's very similar to what we did for the bonds. The difference is notes payable. This is a gross amounts, but it's calculated basically the same way. Interest expense is on the carrying value times 9% is how you find it. So that's chapter on long-term liabilities. I hope this was beneficial, and guess we'll see you in next chapter.